Success in Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You're listening to the Financial Survival Network. It's Kerry, Lutz. And hey, schedule little distorted this week. As you know, was away, just got back yesterday, and today is January 14th, 2015. And with us is John Rubino, dollarcollapse.com, co-author of The Money Bubble. That bubble looks like it's deflating at a rapid clip. What they're going to do about it, that's the question. John, Happy New Year. It's been a while since we spoke last.
Hey, Kerry, good to talk to you again.
Yeah, so, hey, what is going on here? We have uptick in terrorism. We've just got what's beginning to look like the worst of all possible worlds unfolding, don't we?
It does look like there's an awful lot of bad stuff going on all of a sudden out there. So, well, to start with the Paris shootings, horrible, terrible thing for all involved. And I think Ron Paul, as usual, gets this right, though. And that is, his take is that bad foreign policy eventually creates blowback. That comes back to bite you at home. And the West has been intervening in the Middle East for going on 100 years now, since right after World War I, when some French and English guys sat down and drew some arbitrary lines in the sand there and decided these were going to be countries, and they mixed and matched different tribes in these countries. And there's been turmoil ever since. And then we've had to intervene over and over again without having the slightest idea what they're doing, or what we're doing. So we've radicalized that part of the world. Now, the radical Muslims are the ones who are willing to die to stand up to the Western imperialist powers, and because of that, they become heroes, and they draw adherents, and they become a force, and they're able to cause trouble around the world. And basically, that's what we're getting. And this thing in Paris can be traced back to not just some magazine printing some stuff that seems offensive to Muslims, but to the fact that there are so many angry people in the Middle East, and some of them are willing to go to extreme ends in order to make their point. If there weren't so many angry people there, this wouldn't be as much of an issue. And so it's really our fault. Historians are just going to have a field day with the Western imperialist powers, our stupidity in the Middle East. And now, you've got oil once again in the mix. And so it's hard to say how this plays out, except that more turmoil is much more likely than less turmoil going forward.
Yeah, it's not a pretty sight. And, the problem is that that part of the world really is still living in large portions of it, still living in the 16th century. And,
yes,
law of unintended consequences. We try to straighten one thing out, and it leads to just awful consequences.
Yeah.
And to the point where, it's almost impossible at this point to just say, oh, we're just going to leave it alone, wash our hands of it. Right.
Well, that's what we should do. But yeah, that's not a pain-free option either, because if we completely pulled out of the Middle East, there would be absolute chaos. They would have their civil war finally. And you hope their reformation, in which they sort out the role of religion versus the state and come to the conclusion that they're separate things, but that's absolutely not guaranteed at this point. It's important to understand that we originally armed the guys who became Al-Qaeda. Mm-hmm. And then we turned around and armed the guys who became ISIS. They're using our weapons to kill our ostensible allies over there. And in any event, our allies will become our enemies in due course as this all plays out. So, we just frankly don't know what we're doing over there. We never did, and it's getting worse and worse. The mistakes we're making are more and more blatant. And it's all because we think we need to guarantee the flow of oil, when from the beginning we didn't, because oil is fungible. It's going to be sold somewhere. These countries who have the oil need to sell it because that's how they finance themselves. So they're not going to not sell oil. And once it's on the global market, we can buy it just as easily as we buy it now. So if we never intervened in the Middle East, the world would be a much safer, richer place than it is right now.
Yeah, and propping up, we always manage to prop up the wrong regime. That's the amazing thing to me. It's kind of like the way that I bet on horses. If there's one that's going to lose, that's the one that I bet on. The one that's going to finish last, guaranteed, that's the one that I bet on.
Yeah, it's like me with short-term stock trades. It's a perfect negative indicator. But, in the Middle East, there is no right regime and wrong regime because they have to work it out themselves. So anything we do is just going to make it worse, because the minute we support somebody, they, in the eyes of the rest of the Muslim world, become tools of the West. And you can't be associated with us and still have legitimacy over there. So, that's what's going to happen to Saudi Arabia pretty soon. They're prime targets for terrorism and for some kind of really chaotic regime change at some point. And it's going to be traceable back to the fact that they're seen as our puppets over there. So, get ready for more. This is only going to get crazier from here on out.
I subscribe to the Randy Newman school of diplomacy. He said, they all hate us anyhow, so let's drop the big one now. So,
well, and you know what? That's a joke, but that's also seen as a legitimate policy option by a lot of the guys in charge right now. Let's just keep killing them until they become our friends. And
none of them exist.
Yeah, well, one or the other, until there's no more left, or the ones that are left like us, and somehow, see, that's empire. When you reach a point where you've become a decadent empire and you control a big chunk of the world, you're the Roman Empire again, or you're Julius Caesar chopping off the one arm of each of the Gauls for having the temerity to stand up to him, stuff like that. You start doing these crazy things that in a rational world you would never do, but it appears to be your only option, because the alternative is to allow the empire to dissolve, and that's not an option. And so that's where we are as a society right now. So we're doing some really immoral things around the world in the name of this greater good, which is preserving American hegemony around the world. And we're going to pay a huge price for it. What's happening in France is just the beginning of a process that can only get worse from here.
Yeah, I'm afraid you're right. And, it's just, once you get started, there's no way to stop it. Right?
Mm-hmm.
And pull back and say, all right, we're coming home. And goodbye, you guys work it out. How do you do that?
No, and this plays into economics too, because in good times, when you're growing and everybody's getting rich, it's very easy to paper over political differences, because there's an incentive to let that stuff just simmer in the background while you're making money, but when the cycle turns and when it gets harder and harder to make money and easier to lose money, it becomes easier and easier to look around and decide that it's the fault of these other guys, these others out there, and you can easily dehumanize people who are different from you, and that's when wars get started. So it's not a surprise that big wars tend to happen at the beginning of financial crises, at the end of long booms.
Always it happens.
And yes,
World War I is a perfect example. World War II, World War II is a prime example.
World War II is just an extension of World War I. We never really ended it, because we ended it on such a bad note from Germany's point of view that, of course, anyhow, that's a longer, more involved story.
We don't need to get into that, but so all of a sudden, gold stocks, due to the energy implosion, all of a sudden their margins have gone way, way up, because employment, a lot more competition because of the unemployment in the mining sector. And B, their other extremely large cost is energy, because basically they're paying to crunch up rocks, basically, right? To blow up rocks, which is petroleum based, and then to fetch the rocks out of the hole in the ground or out of the pit and crunch them up and extract the minerals, the metal from it. So when the cost of petroleum goes down by over 50%, by 55%, 60%, mining becomes immensely profitable, which is why deflation, and I don't like to call it deflation because it's not what we're having, but let's just call it deflation for the sake of argument here, is immensely beneficial for precious metals. And also then you see people running out of options in the markets, so they start flooding to precious metals as well, which we might see as a hedge against the dollar, because there is no other hedge against the dollar now except precious metals, right?
Yeah, for miners, it's important to understand that inflation per se is not necessarily a good thing for them if all costs rise as fast as gold rises, because their production costs go up along with their selling prices, and for them it's kind of a wash. And a better environment is when most things are falling, but oil and other production costs are falling faster than the price of gold. So their margins actually widen in this kind of an environment right now. And so, gold's up today while oil once again is down. So that means that today, as for the rest of the last 3-4 months, gold miner margins got a little bit wider. Their business got a little bit easier. And so that's going to start showing up in their earnings later in the year. And so we might see some positive surprises for a lot of these guys, because they've gone to really extreme lengths to get their other costs down. They've laid a lot of people off. They've scaled back their exploration. And so their production costs have been going down irregularly, but still going down for the last year. And now energy is the last piece of that puzzle for these miners. They're already pretty lean and mean, and now their fuel costs are going down. So we could have a reasonably good year in terms of earnings announcements for the miners. And that might translate into better share prices, because they might be the only ones announcing positive earnings surprises. Because most of the rest of the economy is going in the other direction. Retailers, banks, these guys are going to have some very negative surprises for us in the not too distant future. And if the miners are having positive surprises at the same time, then they're really going to stand out. So they might be the momentum plays of the next year.
Don't forget, they wrote off everything but the kitchen sink. They cut their CapEx to the bone. And now, and employees, everything else. I mean, literally counting paper clips. So now what they're left with is they're, cut costs to the bone. They're lean and mean. And the leverage that they've got now with those costs being cut, they're to the bone. Mm-hmm. You got tremendous leverage that's going to see itself at the bottom line.
Yeah. And the way you see this visually, I've got a chart on dollar collapse that is derived from some stuff that Jay Taylor, the veteran mining analyst, told me a while ago. Yeah, and he said you graph gold against the Rogers International Commodities Index, and you watch those two lines, and when they diverge in a positive way for gold. In other words, when gold goes up relative to commodities, then you've got widening spreads for the gold miners. And so on this chart, you see in November 2014, the lines cross. And ever after, gold has been going up while commodities have continued to fall. So that's a widening positive spread for the gold miners.
Yeah. He's one of the savviest mining analysts out there, Jay. And yeah, it's kind of counterintuitive, but he happens to be 100% on the money about it, and a little ironic that it works to their advantage. But yeah, he's absolutely right, and that's what we're going to see. Maybe not this quarter, but certainly next. And yeah, retail apocalypse, John. I mean, December was just an absolute devastation for retailing, like we knew it was going to be, right?
Yeah, well, the consensus in the mainstream is that falling oil prices means cheaper gas, means more money in the pockets of consumers, means higher consumer spending. But what it also means is falling earnings and massive layoffs in the energy sector. So those two things, it was going to be interesting to see how they balance out. And it looks like they're balancing on the side of layoffs. People are scared now because they're seeing layoffs happen, even if it's not in their family, in other families, because so many jobs depend on oil, and especially in big, previously successful states like Texas, and certainly in the shale oil states like the Dakotas. Yeah, these states accounted for the biggest part of the full-time jobs that were added in the past 5 years. Most of the other jobs that were added were part-time crappy jobs. McDonald's hired a lot of people, big deal, corporate temp jobs. And these were the kind of jobs nobody really wanted in the first place. And they only took because there was nothing else out there. So there were a lot of new part-time workers.
Flipping burgers, right?
Yeah. And so the good jobs were in the energy sector, and now they're being reversed out immediately. There are massive layoffs going on, especially in shale oil, but also in more conventional forms of oil, and that is reversing out a lot of the gains that we saw in employment in the last few years. So suddenly the economy doesn't look nearly as bright and shiny as it did just a couple of months ago. We were reporting good numbers, and everybody was saying, wow, we've turned the corner, we're growing. And what we were really doing was just adding a lot of almost meaningless part-time jobs along with a lot of energy jobs. Well, the energy jobs are gone now. And so we're going to go back in terms of macro statistics, the employment and inflation, we're going to go back to 2010, 2009 levels. And that's going to be a huge shock for the markets and for the political system. And so it's just a question of when the Fed reacts to this. If employment flatlines and inflation starts dropping towards zero, which it is because of energy, and the stock market responds to that by going back down again, then the Fed is going to come back in and take back this whole tapering thing, like it never happened, and announce some kind of a big QE. Yeah, so we'll see a major QE program announced. They might not call it that, but it'll be something along the lines of what they've done before, massive debt monetization. That'll be announced this year. And so then it'll be Japan, the US, and Europe, all on the same page, all buying back huge amounts of government and, to an extent, private sector debt, and flooding the system with newly created currency. And then who knows? And then maybe we finally get that the currency crisis that you and I have been talking about for a long time and has never happened, but it's still in the cards, and it will happen if all the world's central banks just let it all hang out and just start monetizing as much debt as it takes to keep that inflation number from dropping into negative territory, where, by the way, it already is in Europe, and where it almost is in Japan. They've got negative interest rates on government bonds going further and further out on the yield curve now. 5-year bonds in Germany and Japan are both negative. In other words, you have to pay them in order to get them to give you to take your money, and the trajectory in the U.S. is in the same direction. We've got a ways to go, but we could get there very easily since Japan and Germany have already done it. So when that happens, the central banks of the world will just panic. They will just let it all hang out, and then who knows?
And don't forget, outside of the U.S., the market's already anticipating this, John, because gold is trading at all-time highs in foreign currencies in Europe and in Asia. So it's just in the U.S. that it's not trading at all-time highs in dollars.
Yeah, it's really important to understand that gold resumed its bull market in 2014 around the world all except for the U.S., as you said. And so it's really, the story's really been the dollar more than anything else in the last year, because the dollar has really spiked. And that's safe haven money flowing in. People are just terrified about what's happening in their home countries. And they're looking around, and it's hard to see where to put their money. Switzerland is this little tiny country that it really isn't cooperating with people who want to move money there, because they've got negative deposit rates on bank accounts there now. So once again, you have to pay them if you want to put your money in a Swiss bank. And so the U.S. is actually paying interest, minuscule interest, but some interest. And we seem to be somewhat insulated from stuff like the Charlie Hebdo attacks and the energy-related crises that are happening out there and plunging inflation rates. We don't seem to be suffering from those things yet, but we will be. We're not this island that can just continue to chug along in reasonably good shape, oblivious to what's going on in the rest of the world, when the rest of the world is in crisis. We'll be infected by this soon enough. And today the stock market's down, 250 points on the Dow in the U.S. And
bad day's work.
No, yeah. So a few more days like this, and this idea that we're an island of stability will just evaporate.
Oh, okay.
So yeah.
Yep. And, you just look at it and you see that there was just an article yesterday. I should have sent it to you. The Russians now are trying to sell their contracts in the Manhattan real estate market, but not getting out of the market, just liquefying and taking smaller apartments in Manhattan or cheaper apartments and still trying to get the money out of Russia. So, people are telling me, don't worry about Russia. Everything's fine there. Old Vlad's got things under control, not to worry. And, to that I say, no. I don't think so. And, it's just not happening that way. Just ain't happening,
Well, Russia has, they depend on oil exports. And so they've seen the revenue from their oil exports cut more than in half in the just the last year. Brent crude was $111 in mid-2014, and now it's $46 today. So that's
WTI.
Yes. Yeah, which is an unusual thing in its own right. I'm not sure what that means, but it doesn't happen very often. So
not good.
No. Yeah. And so their foreign exchange earnings plunged in the last year, but they have a lot of reserves built up, and those reserves those reserves are in dollars, which are way up, and in gold, which is also way up. So they're making money on their investments at the same time that their current income is going down. And so they've got a little bit of a cushion. And again, who knows? Who knows how long this goes on and what the long-term effects are around the world. But for Russia, it's a safe bet that they can't manage the current environment for another 2 or 3 years. They can get by for another year on their reserves, and then what happens? Who knows?
Yeah.
So
people know. The government, the people know. And the people are going to rise up, and they're not happy,
Well, that's the U.S. hope in this whole geopolitical thing that's going on with oil, where we contributed to forcing down the price of oil in order to punish Vladimir Putin. And the ideal end game would be for him to be thrown out of office and somebody we like better being put in place. But that's a crapshoot. When you do something like that in Russia, who we get instead of him is anybody's guess. And there's no way to know whether it's somebody we like better, because there's a spectrum there. And that spectrum goes from reasonable Democrat all the way out to a fascist dictator. And so you really don't know what you're getting when you do something like try to overthrow Vladimir Putin.
Yeah, make sure you know what you want, because you just might get it.
Mm-hmm.
So, we're in for interesting times ahead. And I say, to me, gold always been an insurance policy against chaos, and that's more so than inflation, because it moves willy-nilly against inflation. Sometimes it's moving great with inflation. Other times it's not. But in terms of instability, it's the ultimate hedge, right?
Well, yeah. And, in the long run, it is a hedge against inflation in the sense that when currency values go down, gold is one of the things that holds up in that kind of an environment. But yeah, in the short run, you get all kinds of bounces around. So it's not a trading vehicle if you're using inflation as your target indicator. But it is a place to hide out when things get crazy. And the crazier things get in the world, the more attractive gold becomes, because it is the least crazy asset you can own. Real estate is pretty good because it just sits there, but it's also an easy target for governments to tax. And you really don't know what's going to happen locally, and you can't take your real estate with you if you need to bug out.
Yeah.
Gold, on the other hand, you can move around very easily, and it's harder to track and tax. And so it is the ultimate safe haven. And the crazier things get, the more attractive gold will get, other things being equal. So that's a fairly safe long-term statement. Short-term, who knows? But over periods of decades instead of weeks and months, it's been true throughout human history.
That we know. Over the long haul, there is no better hedge. But when you've got a currency that's whipsawing back and forth almost by the day, there is nothing that will really protect you in the short term. It just can't work that way. Just because everything's priced in dollars. So the dollar is going nuts with its values, so you just don't know. Anyway, we got to go, but find John's work at dollarcollapse.com. And, of course, you'll always see a link to his site on financialsurvivalnetwork.com. Sign up for a newsletter. John, we'll talk with you again next week. Be well.
Great, Kerry. Thanks. You too.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.